Now, as we pivot towards the international market, now because of all the issues with Bloomberg and whatnot, like we're filming this at 4 p.m. on April 26th. So clearly, crude prices have gotten annihilated at this point. And a lot of this is the headwinds that are viewed on demand. But as we know with a lot of other things, the futures market has become more about fund flows and is it risk on, risk off? So I would say that this move is a bit overdone. Do we have a bounce? I think we do. I think the trend is still lower, but there's a clear floor in terms of kind of where we're going. In the near term, I'd say Brent doesn't really break 75. If we're at 70, like right now, we're at 77.62. I'd say we touch 80 before 75. If I'm a betting man, I would say that we get that bounce. But I do think that 75 is in play, and that's a likely thing that's going to happen. But it's going to be driven based on what are crack spreads doing and what are things that are happening. And the crack spreads are telling us there's problems ahead. And that's why we see more of this pressure being pushed through the system. But even as that is happening, the key Russian crude prices in Asia have stayed above the G7 cap. It's going to stay above the G7 cap. The $60, as we've said from the beginning, it's not going to pivot anything. We're still going to see it. There's ways around it. We thought the cap was stupid from the beginning. Here we are. And now it's going to be a matter of what comes next. And as you get more and more volume sitting on the water, it's going to naturally push Russian crudes back to the cap, but not because it worked, but because of market fundamentals. And that's the key component of where we kind of sit right now. But the biggest issue at this point is, we do see some of that bounce. The question is going to be, where are some of the flows? Like right now, we're looking at PXD. Essentially they're guiding towards pretty normal production levels versus what was expected. Is that good or bad? Is that I don't think there's going to be a pivot, because some people have asked like, all right, well, if WTI keeps coming down, are guys going to slow? It's like, well, shale price, shale crude at 74. You're not gonna ramp up. Like, you're not sitting there buying new equipment, ordering things. You're just kind of looking at what's here, and it's like, well, it'll probably bounce around here. Could it go to 65? Maybe. At 65, am I going to change my drilling schedule? The answer is no. I think the bigger issue is, are we going below 55, and are we going to be down there for north of 6 months? That's when I think you could start to see some real panic and some activity. Until then, especially at north of 70, you're going to see things moving as is, and that's going to be an interesting thing going forward when we look at some of these different pivots. So then when you start looking at crude availability, so Middle East crude floating storage, dipped down a bit, going following to essentially that 2022 path. But one of the key pieces of why was on the heavy side. So for those that have watched some of the other shows, and for those that have watched or read some of the stuff that we wrote this past week, we had talked about how heavy barrels were in a bit short supply, and that started to create a bit of a panic. And you actually saw some Angolan cargoes get picked up. And as we were saying, it was going to be a matter of, well, people are concerned about some of that quality side. The Middle East still priced itself out. So you did see some of those Angolan cargoes that were sitting there. There was about, I think when we did the EIA show, there were 3 or 4 left. When we did the FSC show, there were 2 to 3. And now that has cleared for May, but which is still very late. But again, that's because of some of that quality concern. And again, that has kept some of the things moving forward. We think it stays, Middle Eastern crude floating storage stays to the high end, especially because you're starting to see additional reductions in price. And that's usually because people are looking for alternatives. Crude exports from the U.S. remaining elevated. That's not something we see changing, just given some of the pricing scales from the OSPs. But now when we turn to Asian crack spreads, you can see that we're getting ready to break 14. And just given when I struck this chart versus now, it may have already gone below 14. But we do think that this is a trend to 10. And at 10, you're going to get economic run cuts. And that's where we do see, and we've been talking about issues and concerns about Southeast Asian refinery activity. And if it settles out at 14, I don't, and maybe bounces between 14 and 15, I think there's enough excess out there that you'll see run rates remain firm, especially because we've seen run rates fall from $8 to $2. And so there's still enough margin there that you'll see activity, which is my point, where if we go from 14 to 10, that $2 is gone, you're in negative territory, guys are cutting. And that's going to be the key piece to watch. And if anything, I would probably say this chart is most likely the most important chart, or at least, this crack spread is the most important crack spread in the whole energy market. And that's why I think this is going to be an important one to watch. Swaps here, you can see Dubai, in terms of where things are versus Brent. This is why we saw some of those movements. We're seeing some of these shifts in general. Again, a lot of light demand. We don't see that changing in the near term. And that's when we look at pricing. And the reason why is because global crude oil on the water is at a seasonally adjusted record. And if you look at it, we're pushing hard towards that high that we achieved in 2020. And if you look, we're at the highest level in 2023. A lot of this is because of the amount of product Russia's putting on the water and just the amount of just floating storage that's sitting there struggling to find a home, as there remains still a lot of crude in transit. And this is why we think that there's more pressure. So even though we have these cuts coming from OPEC plus, not that we've seen it actually come through from the level of Russian cuts that were announced. It's going to be interesting to see how this progresses, where this progresses through, and how that continues to again move through those numbers in general. So again, still a lot of those different pieces and a lot of this overwhelming amount of crude sitting there, which is why when you look at crude oil in transit, we actually took out the 2020 highs. And that's the concern, because the transit crude will end up in floating storage. But even with this amount of crude in transit, we still have a very elevated amount of crude in floating storage, which is why even if the OPEC cuts work, it's going to take time for that product to come out of the market. We're seeing additional price cuts. So there's still a lot of pressure in the physical market that hasn't abated yet. The fact that Angola was able to clear the fact that Nigeria was able to clear some of their barrels is a good sign, but it's still early, and we need to see now what happens for June loadings to see how quickly that clears, to say, okay, that was kind of a one-off. Things are going to tighten up a bit. Right now things are looking a bit problematic. Crude oil and floating storage, we're at 2021 levels. And the problem is we're at 2021 levels with 2020 level crude in transit. And that's the disconnect that we keep seeing. And that's the concern that we have in the physical market in terms of physical barrels available in the market. There's a significant amount, but not all crude is created equal. Crude quality matters. And even though there's a ton of crude in the water, a lot of it is on the lighter, sweeter side. So you still get some premiums when you're looking at some of those underlying flows. Asian floating storage, here you can see dropping down, but there's a lot of product heading this way, which is why we still see a decent amount of floating storage builds coming into the Asian markets. China's super tankers, again, reason why, here's the super tankers taking out the 2023 highs, now really approaching the 2021 highs and moving higher. And this is happening with still an elevated amount of crude available in the market. So if based on these numbers, so let's just say we're in a normal market, Russia's selling to Europe, based on these numbers, I would say that West Africa is sold out and selling $2-3 above OSPs because they're sweeping the West African markets. But when you look at the market, West Africa is still very long crude. The Middle East is still very long crude. And yet you still have these numbers, which again is showing how much market share Russia's really taking and how, and then the next logical take is, well, if most of this Russian crude used to go to Europe and now it's going to Asia, well, therefore, Europe's going to be buying what they used to buy, and this should balance out. And you just have to look at Nigeria, Angola, CPC, Libya to say, well, they're not. And it's really driven based on, again, economic pressure. Chinese congestion, as you can see, bounced. And if you look, it's almost perfect to 2022 at about a 10%, 15% height versus last year. And that's something that we think is going to get maintained, which is something that we continue to see going forward, which is a net positive, while we have refinery run rates remaining a bit depressed. We see this starting to level out, but there's China set records for run rates in March. There's a lot of product in storage. And that's where it's going to be important to look at the new export quotas that will be issued for the second half of the year to see how much is sitting in storage and how much could potentially really be pushed into the market. West Africa had a big reversal. Again, some of this is going to drop back down. It's all about timing. The fact that we had some of those sales, so we will see a drop. But even when it drops, it's still going to stay at a very high level because there's still a lot of Nigerian cargoes available. There's still some time to sell. This could come down more than we're expecting. But right now we see this tracking closer to 2022 levels. Now, when you look at the U.S. continues to export a lot of crude, another increase of 248,000 barrels a day. But as we were saying last week, gasoline exports dropped 209,000 barrels. Distillate 33,000. Again, all of this is moving now below the 5-year average. Propylene had a big drop of 463,000 barrels a day. That's still above the 5-year average. Some of that is timing, but again, you're still seeing some of the pressures that are really going to hit hardest at the refined product point. Gasoline exports drop below the 5-year average. As you get more Russian product, as you get more Chinese product in the market, as you get general slowdowns in economic movement, consumers, we see this actually now moving, and gasoline right now hanging around the 5-year, but really trending below the 5-year average with some of those pressure points. Distillate well below the 5-year, as that amount of volume just comes into the market from Russia. This is going to remain the case, and we're still going to see, again, a lot of those pressure points continuing through on that period. Oil exports remaining strong, not changing. Ethane, again, just kind of bouncing around. Still, that's going to remain above the 5-year average. So, again, not too much in general. But realistically, the propane numbers, again, falling. It's going to ebb and flow. It's just a matter of just where products go. That's going to stay strong. So, it's really NGLs will stay robust into the broader market. But we see refined products really getting hit hard, and that's going to result in more builds, not only in PADD 3, but also that pressure on the crack spread side. Now, when we turn to Fujairah reported 19.96 million barrels a day with a drop of 2.911 million. The drop was across the board for light distillates and everyone else. Light distillates fell 1.692 million. East of Suez gasoline market got a bit better recovering, and a lot of that was just driven based on the end to Eid, the end of some of these different pieces. But the Asian markets is still under somewhat downward pressure amid expectations of a new batch of Chinese export quotas, and as demand from Indonesia and Malaysia is expected to really taper out post that Eid celebration. East-west spread is too strong at current levels for Argos to arb out to Middle East Africa. So you had a nice drop. We do see that adjusting, and again, the rumor mill is out there. Those China quotas are going to dictate a lot. And based on what we're hearing, it's going to be fairly sizable. And again, that's going to put more pressure in terms of where things are. Middle distillate dropped 13,000 barrels. East of Suez gas oil market remained under pressure. just amid healthy regional supplies. And that's what we've been saying, is that the middle distillate market, it's not going to just snap back this, get massive builds, but you're getting that slow grind, and that negative sentiment is still lingering. It's still there. There's more unsold cargoes for May loading dates, which is a problem. Typically, that is something that clears fairly quickly, especially given the last 2.5 years. So that pressure is mounting, and again, that's where we see more weak demand. Gas oil, mainly used for heating in Europe, so weak demand and a little spot trading as temperatures continue to rise, things to normalize. Again, that's going to be a problem. Heavy resid fell 1.206 million to 9.66. Spot trading activity at both the bunker hubs ranged was pretty tepid. Some of this was timing delays. Again, we just see broader builds, and the crack spread supports so. Brent time spreads just got absolutely annihilated. There, it's back into contango. Again, that's something that is going to kind of balance out. We see this moving essentially between contango and backwardation, but not like steep contango or steep backwardation, but just kind of balancing back and forth, because it's a fairly tepid market, but there's still some supply shortfalls. There's still some demand moves, which is going to keep us, I think, kind of fairly balanced at this point. Now, when we look at flows, here you can see Nigeria, coming for May, coming in a bit light, but even with May being light, they still can't sell. Angola, fairly normal versus the last couple of months, like can't really sell. That's the pressure that we keep seeing, and that's the problems that continue to roll out. Angola, Senegal sold 1 cargo each of Dahlia, Clove, and Gasoil for June loadings to Shell. Nigeria plans to cut some additional exports. Vital offered, Agbami basis at 5 cents more than dated Brent. Senegal spot sales, Shell purchased 950,000. When you look at some of the different on the final prices, it was offered at minus $1.20. And then when you look at a million barrels of Gasoil was offered at dated $2.70. So the question is going to be, where is it moving? And then when we look at some of the other ones, some spark cargo, so the higher OSPs for heavier Saudi grades prompted some buyers in Asia to turn toward Angolan crudes. And again, that's something that was beneficial in general. Then when we look at some of the flows, 45 cargoes of crude are due to load for Asia this month, equating to about 1.4 million barrels a day, which was revised, for April. It was about 1.36 in March. So still on the low end, but a little bit of a bounce. So you're still seeing some fairly steady flows in general. Again, not much to say in one direction or the other. Now when we look at Genscape for Europe, the small draw. But when you look at floating storage, which we'll show in a minute, we still see this moving higher. Gasoil had a small draw of 2. Gasoline had a more sizable drop of 64. But again, you had builds in naphtha, builds in fuel oil, and builds in jet. So again, you're starting to see a little bit of those problems that we've been talking about. Gasoline just dropped slightly below 2022. Based on the ARB, this should continue to drop as a lot of that product is unleashed into the U.S. markets. Fuel oil is a problem. Fuel oil, as we said before, on the arbitrage going east-west before, now looking west-east, it's no different. I mean, there is no ARB. So a lot of this fuel oil is going to build up in the European markets. Then when we turn to Singapore, the holistic number is still above average. We don't see that changing. We did get light distillates coming down a bit. It's now below 2020, but still second highest of all time. And one of the things that we've been talking about is as Eid kind of clears and we get a sense of where things are, we see bills staying at the very high end. It may not go back above 2020, but again, it's going to stay under pressure. Same can be said with Middle East. The middle distillate, you had some drawdowns, but we see that building a bit back up as some of those additional flows come through. Then when you look at resid, again, very negative, and this is, I think, kind of a bellwether of where some of those emerging markets are going to go, showing some of those cracks. North Sea continues to see some of those small builds. Again, on the floating storage side, that should continue to trend up. And then Europe, as we were saying, as they draw down more on floating storage, that will put more on land and, again, send those cargoes back higher. storage levels back higher. So that's what we have for you today. I apologize for the delay. Always fun with technical issues. So if you have any questions, again, please feel free to reach out. We hope that this was helpful, and we'd love to hear from you if you have any questions. And please like, share, subscribe. Push this as hard as you can. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.